All right, let's get in the trenches. Real quick, Scott, what's the one thing you're going to watch headed into the weekend? I'm watching the dollar because I cover commodities and gold. What's the one thing?
I'm going to watch the dollar also. The dollar, and also I've been trading the FXC, so we're going to use that as a barometer. As the dollar keeps rallying, a lot of people are selling the commodities and they're selling equities. So that's a relationship that's working right now. That's what traders are watching, and they have them all over their screens.
And talking about a barometer, I think we are going to go through the ETFs and the different sectors to see which one's holding up and what we can learn from that as a market as a whole. Now, we did already cover the OIH, and I want to go to the semiconductors holding up pretty well, over 6%. It stands strong. What does that mean? Is that a bullish tech indicator?
Well, it's something to realize and something to watch. What I want to do in this sector with you is check the temperature of the market and show the sectors that have been acting best, what to look at just in case they start breaking down, and show you how you have to pare down positions regardless.
Right.
You know, when you're in a market correction, the tide takes everything. But the SMHs, you look right here, they're still above their 21-day, and they're still above the 50-day. Intel's been acting very well lately. We need to make sure that continues. If you see the SMHs start to break below, I would say 35.50 and breaks the 21-day, I would get out of some, and then we'll see how it handles the 50-day and maybe gets down to lower support. But this has been a strong group, and strong groups typically try and hold their 21-day. If they don't, you sell some, and then you watch the 50-day.
And talking about strong groups, we've got to go to retail. They seem totally counterintuitive. Semis and retail up over 5% in the second quarter, and then especially strong yesterday on the back of Macy's killer quarter. Let's take a look at that chart.
Yes, RTH looks very similar. Look at this. This isn't even close to the 21 days. So what I would do is I would take some off into this strength because, again,
oversold.
No, it's overbought.
Overbought
right here.
Yeah, overbought.
We're not even really overbought. It's just, you have to raise cash. When in times of volatility, you raise some cash because you could easily see a move back down to this 21-day as the market comes in, and that would still be a healthy sign. So as long as the RTHs stay above 110, you could stay with that group, and it'll continue to outperform.
And the transportation index, also sort of a really good barometer for the whole health of the market, kind of iffy. I mean, up almost 2% for the quarter. Not that great, but not that bad.
Let's take a quick look here. What's that, IYT?
Yep.
IYT. First down day yesterday. It is also above the 21-day. So as you're seeing here, you're seeing some similarities in these strong groups. They're all at or above the 21-day. So see how it acts around this 97.37. It's been on a nice, it's had a nice move from the 90 level. So watch this area. These strong groups are the ones to watch to see if they continue to be strong. If they start breaking the 21-day, this correction is going to move lower quicker.
But on the flip side, if you watch the sectors that haven't been doing well and they start to do better, wouldn't that be a sort of bullish indicator, a little more optimistic?
Well, there are two ways to look at it. The sectors not doing well below the moving averages are going to be the groups that most traders short first as the markets move lower. One thing you have to look for to see if there's rotation, because sometimes what's been going on lately is weak sectors have been getting stronger, strong sectors have been getting weaker as money's been going around. But the typical rule is you short the weakest sectors first because they have followed through to the downside in corrections. And the MOO, I've tried to be long, Potts, Moss, all those guys. This group is breaking down. Look at this group compared to what we just watched. It's below the 21-day, the 50-day. It's at major support. So traders are probably going to be shorting these MMOs. And look at this pattern, this rollover here for a move probably back to support in this 50 area. So this is a group that you have to watch this level. It could break down further. It's not looking so good.
Especially today, because we heard yesterday the crop report for 2011-2012 in the U.S. selling season that there'd be record corn production, high pricing, but inventories would actually rise a little bit more than expected. They're still low-ish, but they're a little bigger than we thought, which might put some pressure on demand to sort of catch up. Demand has to be that strong. So I think a lot of traders, especially yesterday, or investors actually sort of dumped all those stocks in fear as an excuse to sell, but maybe at some point there'll be some kind of support for longer term.
Well, rightly so. So if they got out yesterday, that's good, because then they'll be able to buy back at another price, and that could be down here at this 50.70.
Right. All right, let's go to banks. Also not doing too well here. It's sort of the ugly sector.
Yes, it's been ugly for a while. For like a year and a half, the banks have been ugly, and we've highlighted it. We've tried to be long, and we've gotten a little bit hurt here and there, but we're not getting too enamored with it. If you look at the XLF, you'll see here also that it's below the 21-day, the 50-day, coming into some bigger support. If these XLFs do not hold this 1580 area, you could see another move down here in the banks. And we've talked about JP Morgan, we've talked about Goldman Sachs. Goldman Sachs is below that important level that we talked about. So these banks, are going to be a group that traders try and lean on, and we'll have to figure out whether or not some money goes there. But at this particular point, this is a weak group and could be, you know, a headwind for the market as well.
But I would argue, too, that it's hard to look at the banks as a barometer for the market as a whole, just because it has so much Washington headwind. It's sort of like out on its own as sort of the unloved sector.
Well, it hasn't been, you know, I don't think any trader's been like judging it, because if you judged it, you never have been long last year. We've made new highs, we've had great action. The banks have been, like you said, the ugly stepsister,
Yeah.
but for now,